Mutual funds continue to be the favored investment options for investors. In August, despite the market crash, equity inflows crossed 9,000 crores. Is this trend likely to continue? Joining me to talk about the current market and what investors should do is Kalpen Parekh, CEO, IDFC Mutual Fund. Thanks, Kalpen, very much for joining me on the show. We've seen equity returns sort of pare down over the past 1 year, and debt returns have been quite strong. What should be an investor's equity debt allocation at this point?
I've always said that, if your time horizons are really long-term, which is, over long-term really means decades of investing, you could be 100% in equity if you can digest the volatility. Alternatively, your horizon is 10, 20, 30 years, but you can't digest any market fluctuations, and don't be in equity. And you're right that, in fact, over the last 3 or 5 years, in the last 5 years particularly, there are bond funds which have done better than equity funds. It's a function of market cycle. In equity, what is important is, one, the earnings growth outlook, and second, at what price are you buying those outlook.
Right.
So like I said, 2 years back, while earnings were muted in India, earnings growth was muted. However, valuations were still cheap. Markets were priced at 14, 15, 16 times, and there were pockets of opportunities. Now, in the last 2 years, all these valuation gaps have not narrowed down completely, and earnings have not recovered. So that data point determines what should be allocation. So we, for example, in the last 1 year, have been guiding investors to rebalance allocation more towards fixed income. Fixed income looks a more compelling trade investment idea right now, primarily for 3 big reasons. One, for the first time in the last 10 years, real rates in India have turned positive. So bond yields are closer to 8%, inflation is at 5%. So after a long point in time, you're getting 3% real rates, which is a very compelling argument to have long duration in portfolio. Number 2, we are not seeing a very large recovery in growth in India, and globally there is still fear of deflation. In an environment like this, typically interest rates tend to stay low or go low. Right. So, and the third thing, we saw 2013 was a period where, for a brief period of time, India had a funding crisis. There was a currency, trade which went against us, and bond yields turned volatile. But since then, India has really earned its glory in terms of repairing its macro structure, and the funding crisis has largely been taken care of. So much so that our current account, our fiscal deficit, all variables have turned significantly stronger. So these 3 triggers actually call for having a reasonably large allocation towards fixed income, particularly managed actively.
How has it been post Kenneth Andrade's exit? Because I mean, the IDFC Premier Equity Fund still continues to be performing relatively well despite the market volatility.
So of course, Kenneth was extremely instrumental in building the platform and bringing Premier to where it is, aided with a fairly strong team. And Poonam, who has been a part of our team, has been co-managing Premier along with Kenneth right from the inception of the fund for the last 10 years. So that continues. Investment principles continue. Thankfully, the design of Premier is very unique, where we take money only through SIPs. So we've got a very good base of retail SIPs, and we've got staggered inflows every month, number 1. Number 2, Premier again has a very different intent. It says that it doesn't hesitate in stopping flows if we don't think the time is right, or if we think it's not the right time for investors to put more money. So if you notice, in the last 10 years, the fund has remained shut for almost 7.5 years. We've taken money only when the environment is right, or we see new investment opportunities. I think investors recognize this intent and design, and this design has helped investors earn meaningful returns over time.
So what about the other IDFC equity funds? I mean, there has been comparatively some amount of underperformance. What would you sort of like to tell investors, and what would be the strategy going forward be to sort of enhance returns?
Over the last 1.5 to 2 years, what we've seen is markets have been driven more by reversion to mean on valuation, but not enough growth on earnings. And to that extent, we've run portfolios more defensively, and we continue with that approach. We've not participated in that part of the market where, in spite of no earnings growth, stock prices have really run up. So we intend to continue with that discipline and run with the same investment principles. Over and above that, I think where we try to, how we guide investors further is by giving them a right framework. So we take pride in telling investors what is the right time or what is not the right time to invest, and that is another way of, making meaningful returns for our investors.
Okay. So just taking that point forward, I mean, what is your view on the current volatility that we've been seeing, and how long would you expect that to continue?
Yeah, I think markets are doing their job of going up and down, and they'll continue to always behave in that fashion. More so, we are largely driven by international flows, and global volatility is something that is very difficult to predict.
Right.
So my expectation is volatility will continue. Investors need to accordingly align their expectations and their behavior and their allocation. I think you can't wish away volatility from the markets. If one wants to earn extra returns, volatility can actually aid you in that process. The principles that have always worked for us is, invest for long. And long really is not 1, 2, or 3 years, but 5 to 10 years. And invest when you don't see too much of euphoria in the market.
Right.
Those are good times to build portfolios and grow.
One important cue, of course, will be what the RBI does towards the end of this month. What are you expecting, and how important a cue do you think that would be?
There is room for softening.
Okay.
But we think that this is going to be a slow cycle over the next 2 or 3 years. Interest rates will head lower.
Right.
There is a very large real rate available.
Right.
And RBI will accordingly respond.
Right.
But would it really impact market? Would that be the only criteria? I don't think so.
Right. So as a fund house, where are you really finding value? Which pockets in the market are you finding value, and how have you seen valuation sort of correct in the past few months?
We haven't seen material correction yet because the run-up has been very sharp without commensurate growth in earnings. There are pockets. So, we see government actually taking advantage of correction in oil prices and commodity prices and using those surpluses towards capital spending. So capex is gradually picking up in some pockets. We are seeing that happening in roads, for example.
Okay.
So there are pockets of companies in that space where there are opportunities. We are seeing some opportunities in T&D.
Okay.
But overall, there aren't any large trends that we can pick up at this point in time.
Okay.
Historically, we've always run portfolios thematically by identifying trends and aligning portfolios around that. But this is a phase where no big trend is available. Neither is valuation comfort there. And hence it is...
so it's more stock picking that you have
to basics, pick your 25, 30 companies right, give them time and be patient. I think being lazy will be very important in this cycle for investors.
Okay, we'll leave it there. Thanks very much for joining me. Time for a short break. We'll come back and talk about the Forefront Alternative Equity Fund. Stay tuned.